Elroy Lobo, Chief Strategist and Global Head Equity Asset Management of Kotak Mahindra AMC, joins us live now. Elroy, morning. Good to have you back. Elroy, of late things have been rather volatile for Indian markets, and honestly, depending on whom you're asking, you will get a different answer. The opinion on the street is split right in the middle.
No, I think it's a function of a view on how the macroeconomic environment will shape up. And what we are seeing on the ground is that in number of variables, things are getting positive. The only concern that investors now have globally is the view on currency. And if currency does stabilize, I think the view will get more crystallized, and I would see a more favorable opinion towards India.
But Elroy, what would it take for the market to actually, conclusively break past that 6,200, 6,100 level? Because clearly it seems like there is a tough ceiling at that mark.
See, there's a short-term view and a long-term view. I think the markets, could take a pause in the near term, given the fact that in rupee terms it has, held up pretty well. I would say that the concerns in the market now seem to have changed from what we have seen last year. If you were to look at last year, the concerns were more on India, likely to see a dating downgrade, inflation being pretty high, growth rate basically decelerating. As we move into this year, as some of these parameters seem to have reversed, you're clearly seeing fiscal deficit being under control. You're seeing a potential, possibility of growth rates recovering in the second half of this fiscal year. Our current account deficit, is clearly seeing positive, movements, mainly because of lower commodity prices. Gold is the only, negative spot there where we are seeing increased, gold demand. But if you were to look at the current account, it's clearly going to benefit from lower commodity prices. Our capital account has become extremely strong on potential FDI investments, as well as you're seeing good portfolio investments both in debt and equity. So net-net, the macroeconomic environment, in my view, is getting far better than what we've seen last year. I think we need to see a little more stability on the currency. Currency seems to be the weak point right now, and it's coming more from the strengthening of the US dollar rather than any major change in the domestic fundamentals. Once that is taken care of, I think you will see a very favorable view towards India from all investors.
Elroy, if that was the story, the dollar index in last 2 or 3 days has gone down, and still Indian rupee is the worst performing currency in the entire region. Is it too naive to really blame the weakness in rupee on dollar?
See, it is obviously you're looking at a few days, but by and large, I would say that if you look at the trends as far as the current account or the capital account is concerned, my sense is that the balance of payment this year will look much better than last year, and it's coming because of very, very strong portfolio flows. Just take the case of the three components of capital flows. One is clearly the FDI. We're already seeing the Unilever increasing stake in their subsidiary in India. We already saw Glaxo increasing stake. We're seeing the Diageo deal with United Spirits. We're seeing the Jet Etihad deal. So this clearly shows that the strong long-term money is clearly coming into India, and that is going to strengthen our capital account. Second is that on the portfolio flows into the country, last year we saw $24 billion into Indian equities from foreigners. This year we have begun with about $15 billion calendar year to date. Also on the fixed income market, with the opening up of limits and a reduction of withholding tax, we are seeing flows on debt also being pretty good. So on all the three fronts, the capital account is looking far stronger. On the current account, my sense is that the oil prices will remain relatively soft, and that will help the India story. The only, like I said, negative spot is the gold imports, and I would see the government imposing more curbs to reduce the demand on imports of gold. If that really happens, we are actually looking at a very, very favorable balance of payment, and that, in my view, will help support the rupee and prevent it from very steep depreciation from current levels.
Alright, since we're talking about currencies, how would you approach currency sensitive sectors? For example, the likes of NIT and in particular INFI, does one now look at it in a new light with Mr. Murthy's comeback?
I would say that currency is like the icing on the cake. If it helps your case, the better it is. What we look at is the underlying fundamentals as far as growth is concerned and demand is concerned. The IT sector, in my opinion, has become pretty large. Companies have become large, and to grow up that base is becoming extremely difficult. And therefore, we're looking at just about low double-digit growth for most of the major companies in the IT space, with some of them even likely to report growth rate even below double digits. So growth is clearly going to be, more tepid from what we have seen historically. As far as Infosys is concerned, yes, with Narayana Murthy coming in, things are definitely changing. I think Infosys, there was a view that they needed much stronger leadership, and I think with Narayana Murthy coming in, that has infused some kind of confidence. Things have changed, however, since the last 4 or 5 years as far as the dynamics of the industry is concerned. So it's going to be a challenge out there, but definitely the scenario is much better than what it would have been, without Narayana Murthy being there.
Would you be a buyer in Infosys then? Because the price difference...
Infosys has always been a stock which has got a lot of value. I think that value was not being unlocked purely because, investors were not very clear as to the growth trajectory given the way the company was managed in the last few years. My sense is that discount, will start getting bridged. But once it gets bridged, it's back to basics to see whether, the growth of the industry itself is sufficient enough to justify a further upgrade.
For a company which is only growing at 5 to 6%, the stock is still trading at a P multiple of about 11 times. Do you think in the near term the P multiple for Infosys is unlikely to expand?
I would say for the whole sector, there will be a cap on terms of, multiple expansion. Remember this, like I said, the sector is becoming pretty large. What this means is that it is getting more levered to global cycles, unlike in the past where we saw secular growth despite global cycles. So in that context, valuations cannot, expand very materially. Second is that margin compression will be the order of the day year after year. Competitive environment is clearly increasing. Wage costs are increasing. You're seeing a lot of, new regulations on immigration, which will put pressure on the IT margins. And therefore, it's not, we're not likely to see a very material expansion in valuation multiples. However, discounts that exist in the sector because of reasons other than, the fundamentals of the industry, if they start getting addressed, then those discounts can get, closed. And that's what we are seeing, likely to happen in Infosys.
What about autos? Is the pain now in the price, and can we see a turnaround when it comes to the monthly sales data and generally the pickup in the entire space?
Now, I would say that we are very selective in the auto space. There is clearly, slowing demand in that in a sector. It will benefit as a rate sensitive, when you see the transmission of interest policy rate cuts into lending rate cuts. So there will be some amount of benefit that the auto sector would get. Some of the pent-up demand also would start coming into play. But I would say that at this point in time we are very selective on the sector.
I think the best part of the rally in Maruti is now behind us. Yen clearly has strengthened in the last 8-10 days. And if I look at the kind of dispatch numbers what Maruti has reported, at least for the month of May, they are losing, and they are losing some market share.
Yeah, I would agree. Like I said, we don't look at currency as the reason to play stocks. The underlying fundamentals have to, be strong. Currency is like the icing on the cake. So if the yen is, showing signs of depreciation, and that's, we would not really go and buy Maruti unless the underlying volume growth of the company is pretty strong.
Alroy, last 2 or 3 years, consumers and pharma stocks have seen a massive P expansion. Stocks have expanded more, earnings have not expanded. Do you think the P multiples for consumer and pharma stocks will expand? If not, which is the other sector where there is scope for P expansion?
Now, I would say the expansion in multiples in these two sectors is coming more because of lack of choice that investors have across other sectors in the market. Consumer sector, all said and done, is a sector which is a secular, the theme itself is a secular theme. And you may see valuation multiples expanding, and then they pause, and then they go in for the next, re-rating. So I would say at this point in time, a large amount of the re-rating in the consumer sector seems to have been done. Number of stocks are looking, really expensive. And I would say that, I would see this segment maybe seeing a pause rather than a very steep correction. Market will now wait to see delivery of earnings growth in the sector. As far as pharmaceuticals is concerned, there are various companies with different business models. Each one has its own merits. But by and large, there are a lot of exciting things happening in various companies, be it Sun, be it Lupin, etc. And therefore, there are various stories to play within the same pharma space. So you can't paint all companies with the same brush. And in that context, we still see potential, for investors to make decent returns also in the pharmaceutical sector at these levels.
Although the one space which has seen a steady amount of good news flow has been oil and gas. Do you like anything there?
Yeah, I think oil and gas is looking, pretty undervalued right now, particularly some of the upstream names. I think the market is not taking, a very clear view on, the continuation of the partial diesel deregulation and its impact on earnings. My sense is that this sector, will start getting attention sooner or later, more because of polarization in valuations, across various sectors. The disparity in valuations that you're seeing between, the consumer space and the oil and gas space is so wide that at some point in time, investors are going to sit back and say that these stocks look pretty cheap. And there are things going as far as policy is concerned in their favor. And if oil prices, remain soft, then these companies would, very soon, catch attention. So I would be, looking at very clearly a positive trend, particularly in the upstream oil names, and we would be increasing weight in these sectors. Yeah.
Alright, really good chatting with you. Appreciate you taking the time out and joining us this Tuesday morning.